Hi, and welcome to our On Point webinar, Beyond Underwriting, Strategy and Insights. I am Bridget Height, host and moderator for Oak Street Funding webinars and podcasts. As a note, before we begin, you may or may not have noticed in the marketing materials that we had a little bit of a change to the panelists today due to the circumstances that are out of our control. So today, I am joined by Rob Roach, Director of Underwriting at Oak Street Funding, and instead of Brad Cronland, Director of Strategy and Partnerships, we have Adam Farrig, Vice President of Strategic Market Sales. So we are very excited to have his insights as well. So Rob and Adam, we are going to delve into the world of underwriting and provide insights on how market trends are affecting company strategy, underwriting decisions, and the financial industry. They'll also be answering the questions that you submitted along the way. So the questions that were directly asked to Brad have been sent his way, and so he'll follow up with you shortly. Anyway, Rob, Adam, thank you so much for being here.
Thank you.
Yeah, thanks for having me. Love participating in an underwriting webinar.
It's a big step up for Adam.
Big time.
Good. We're happy for you, Adam. All right, well, to start things off right away, we're looking at the halfway point of the year. So what are the trends that you're seeing related to inflation, interest rates, and a possible recession in 2024?
Sure. Yeah. So, I've said it before and I'll say it again. I think business needs to transact, regardless of macroeconomic circumstances, rising rates. I think we've seen a difference in deal structures, and we've seen a different level of diligence associated with deciding whether or not to do a transaction. But the bottom line is we're still seeing transactions get done and a need for capital in this space.
Okay, great. Do you have anything to add?
Yeah, I think inflation's been very stubborn. And rates have been up a little longer than I think we initially expected. But as Adam said, I think there's a period of time where people were maybe on the fence for a little while, wondering, is this the time that I should do something? Do I need to wait this out? Do I need to see what happens? Right. I think, as the song says, life goes on. And I think, as Adam mentioned, people are into the point now of, hey, this is where we're going to be. Let's figure out how to operate in this environment and be successful.
Okay, great. So how might these market trends you just mentioned be impacted by the election? And then how are they impacting underwriting as well? Adam, we'll start with you.
Yeah, I think both elections and year-end timelines always have a way of affecting transactions one way or another. I think it's the fear of the unknown. I don't know that it's so much a premeditated thought of this is how we know it's going to be, so we need to get a deal done now. I think it's, hey, we don't know how it's going to be. We don't know who's going to get in office. We don't know what's going to happen to the rates. We've seen interest rate changes every election year. I think there was only one time since 1980 there wasn't an interest rate change. So there's going to be changes, and I think people need to be aware, of those changes and conduct their business accordingly.
Sure, Rob.
Yeah, as Adam just mentioned, this type of thing, whether it's an election, whether it's some unexpected event, just puts an amount of uncertainty into the market. And that amount of uncertainty, number one, it causes people to take a pause, maybe take a breath. From our perspective, it makes us look at a transaction slightly different. Makes us put some, ask the question: what if things don't turn out exactly as they should, or exactly as we think they might? We need to put in some room for adjustments along the way, and make sure, both from our client's perspective and Oak Street's perspective, that we have the ability to maneuver based on what the outcome of uncertain events might be.
Okay.
Yeah, I'll echo that too. That I don't know that rising interest rates make a good transaction bad. Like we've done those stress tests on a lot of deals in our portfolio. And if you have a 6% rate or a 9% rate, I don't know that there's enough variance there where we'd say, hey, this was a good deal at 6% interest, and now it's not. So I think it's really just modifying how you look at the deal and what's important to you. But at the end of the day, the interest rates are what they are.
Okay, that's great to know. So we wanted to talk about some of the specific trends that our audience asked about and get your takes on them and how underwriting may be affected. So with increasing financial complexity, are there specific services areas within RIA and CPA firms that are experiencing the highest growth? And then what are the top performing clients growing, and what would look best on a loan application?
Yeah. So I think on the underwriting side, we look at organic growth and client retention, right? Those are two big factors I think that we're looking at when we get into a diligence engagement with somebody. So how well you're able to manage your clients, retain your book of business, and execute for them in the right way, I think is a key testament to how well you're going to run the business, right? So when you look at advisors that do really well, I think it is the ones that have a specialty. They work with the clients that do the same types of things. You see guys that specialize for like airline pilots, guys that specialize working with small business owners. So staying in your lane and finding out how to best serve those clients is a big piece of that. But I think to the underwriting side of it, us evaluating how well you keep those clients, how long they've been clients of yours, makes a big difference in how well you're running your business.
Okay, great. Rob, do you have anything?
Yeah, I mean, I think when you put some challenges into the market, put some challenges in the economy, I think it really allows some of the top firms to show why they're the top firms.
Right.
It shows that, hey, to their clients, I have the experience to deal with these challenges. I have the expertise to help you navigate through not only challenges the market's facing, but help you as an individual client walk through those challenges. And I think that's one of the powerful things that we see when we see an introduction of something in the industry. The cream rises to the top, and people go to where they feel the most, they gain the most trust, take the most trust, and where people can show their expertise.
Right. That makes total sense. Okay. So another trend that we've been seeing is the increase of robo-advisors entering the RIA market. So we've had an audience question: how are these robo-advisors impacting the RIA market, and how are RIAs adapting to compete or collaborate? And how are you preparing for potential underwriting changes for firms with robo-advisors? That's a lot. So if you need me to repeat anything.
No. AI and tech, right? Robo-advisors, that we're just seeing this come into the space more and more.
I never heard of it until recently.
Yeah, right. So a robo-advisor, I mean, that's going to go off of algorithms, and it's going to, manage a client's investment portfolio almost without any advisor engagement, or just with some minimal advisor engagement. So I think it makes sense for advisors that have a part of their book of business that's smaller,
right? Maybe
households that are 100,000 to 250,000, where typically they may need to charge them more than somebody that's a high net worth or mass affluent household because of the time they're spending versus the fees they're collecting. So I think it does fill a space in the market, and I think we will see more of it. But at the end of the day, I think when you look at mass affluent households and high net worth households, I don't know that it's a replacement for true advisor engagement. Right. So that's my thought on that.
What do you think, Rob?
I think one of your questions was how it's going to maybe affect potential underwriting. We challenge it with our own robo underwriting. And so, I think, one of the things, and I've said it, I think, a couple of times, and I'll probably say it again later, that we've really started to talk about is your right to exist as a firm. And, meaning that, what are you bringing to your clients, to your stakeholders, to your owners that nobody else does better, or that, creates your right to exist. And so, one of the things that we look at on something like this is, if the majority of what you're doing is placing people in something that anybody else can do, how's that going to provide the specialty, the niche that, is really what we're seeing make a lot of firms successful.
Yeah. Okay. I think it's a great point. How do you differentiate yourself? Yeah. What's your differentiating value? That may take away from that a little bit, unless it's in conjunction with a bigger service offering that you're providing to the clients.
Right. Okay, so with the increased presence of PE firm competition, what are the benefits of debt versus equity that someone should evaluate?
Yeah, so, this is a hot topic in the RIA space right now. In a very fragmented environment, there's a lot of private equity interest. Okay. And I think a lot of advisor firms are asking themselves, what's better for me, private equity investment, or to use traditional debt for either acquisitions, change of ownership, what have you. And I think what's really important there is to figure out what stage of your business you're in and where you want to go. And anytime you're evaluating a private equity partner or a debt capital partner, I think you have to have a really good understanding of, where you're headed. If you're headed in a different direction than the private equity backing, you're seeking, you're going to have a rough ride, and it's going to be tough to get out of and probably really expensive. Same goes for debt. If you don't have the right expectations going into a debt facility with, covenants and how we manage a debt facility, and, maybe you don't want to show enough profitability to reduce your tax liability. So then you don't meet a covenant, and, it looked good at the beginning, but maybe it's not the best long-term partnership. You're going to have to get out of that debt facility, which can also be really expensive, right? So I think, you really need to pay attention to what's most important to you. On the equity side, if you want to grow and acquire and you have a very specific acquisition strategy, and you're in a stage where profitability isn't of the top priority, equity's probably going to be your route. And then on the debt side, if you take that same strategy, but it fits within the walls of covenants and in a loan box that we see, probably better to look at that.
Okay, great. Thanks for that, Rob.
I would add, for me, it's when you're thinking about those two things, debt or equity, I think it really comes down to, what's your long-term plan? If your long-term plan is, I want to maintain ownership of this company, I want to take this to the, what I perceive as the next level, whatever that next level might be, maybe, and I want to be in control, maybe working with a lender, getting that lender up to speed on your plan early, so that, you, as Adam mentioned, we can set up appropriate guardrails for the lender and for the client to say, here's how we're going to grow there. If that's not the utmost important aspect to the owner, maybe it's, hey, I'm in here for a very short time. I'm here for I'm going to sell in 5 years. Maybe getting some of that money up front where I'm growing. I want to grow as fast as I can.
Yeah.
And I don't want the again, profitability maybe isn't my top thing I'm looking at. Maybe working with an equity provider or something to look at as well.
Okay.
I think it's defining your strategy too. We've talked about it in past On Point webinars and sessions. Defining your strategy is crucial here. If you know exactly where you're going in the next 5 or 10 years, making these decisions and figuring out what works best for you is going to be a lot easier than somebody who's just trying to acquire and trying to grow, maybe has an AUM number that they want to hit or a revenue number they want to hit, but maybe hasn't really looked in the mirror and defined their strategy. That's where these decisions get really difficult.
Yeah. Okay, that makes sense. So consolidation versus specialization is another big topic being discussed right now. Will the RIA and CPA industries see more consolidation of firms offering both services, or a trend towards specialization in each area? So especially related to CPA talent. Rob, do you want to take that for a moment?
Yeah. I think one of the things that I thought about with this question was, are you at a point in your business where it makes sense? Okay. Some people will say, I want to add something just because it sounds really cool to add it. And, I'd love to be able to tell my client that I'm preparing their tax return that, hey, I have an advisor for you to talk to, or vice versa. Those things are great, but is your firm set up to where you have the capacity to include those things? Right. It's a struggle to do something versus, doing it very well. Right. And so, just having the ability to say, hey, we do it, and then having one of your clients not do it well for that client could be a drawback. So, to me, it's, are you at a place in your firm that you can take that on and find the people to do it, find the right partner. And so, if those are the things you can do, then maybe it's worth looking at.
Okay, great.
Yeah. I think consolidation is a staple in both of these industries. We saw it in the insurance space 10, 15 years ago start to happen. Private equity interest came in, multiples went up on the insurance side. And, now we're seeing that in the RIA space as well. I think in a fragmented market like the RIA space, you're going to have that private equity interest that's going to result in a lot of consolidation. The specialization side, as we mentioned earlier, I think it's important to have a specialty. We work with a lot of clients, and the ones that have a specialty that know those clients and know their service offering and can just nail it every time, they serve their clients the best. They get the most referrals, and they have a lot of organic growth. And they have a consistent pipeline, of new clients coming into the fold.
Okay, so thanks for your insights on some of those trends. And now we're switching gears a little bit to talk about the topic of this webinar, which is underwriting. So what are the key factors underwriters consider when evaluating risk? Rob, I'll start with you.
Yes, I thought we'd start with Adam, but that's okay.
Oh, okay.
No, sales guy on the underwriting, I like it.
One of the things we always talk about is, the 5 C's of credit.
Yes.
And what does that look like? And those are character, capacity, capital, collateral, and conditions. And those are very broad. And so, as we're looking at those things, really, what's your past history with handling debt? Have you had debt before? Have you, what does that experience look like? So we'll look at that. We'll look at the capacity. What is your firm's ability to borrow money? And making sure that we don't do anything to hamper the firm, to hamper growth, to hamper what you're doing. Capital, and that goes into the owner's ability to provide equity, whether it's into a transaction, into supporting the company if things don't go exactly the way we all hope. So we'll look at that. Collateral, that's something a little different for what we do. You traditionally maybe think of a building or something, to that effect. At Oak Street, we're looking at, really the cash flows of the firm as our collateral. Finally, conditions. We talked about earlier. What's the conditions not only of your firm and your industry, but also expanding that into macro conditions. And those are the things that right now, as we talked about, there's a lot of uncertainty. It's hard to predict the future. And so those are the things that we're looking at when we're initially talking to somebody about a new transaction. We want to get a feel for those things, as well as what are your goals, what are you trying to accomplish, and how can we help you do that?
Okay, great. Do you have anything to add to that?
Yeah, I mean, hey, the 5 C's of credit, on the underwriting,
are very exciting.
The sales guy, I mean, this is uncharted territory. No, I'm kidding. Right. So on the front end of the house, we really have to evaluate this stuff as well to make sure, by the time it gets into underwriting, we're all looking at the same transaction that we thought we were. The only thing that I was going to touch on, I think Rob, hit the nail on the head, but on the collateral side, for us as a specialty lender to RIAs and CPAs, our collateral is that book of business. Right. And our expertise is in evaluating that book of business to say, how long do we think it's going to be there to pay our loan back? So on the RIA side, I'll say, what's your AUM? How many households do you have? What's your average fee charge? Who do you hold custody with? What's your average length of relationship? How many years? What's your average length of tenure with your client? Are there any concentrations among those clients and the revenue associated with them? These are things that I think separates us quite a bit from traditional banking, where that's our collateral, right? Yeah. That's our ability to understand that and look at it and say, how well is this going to pay our loan back? It is what gets us comfortable with the collateral of that business.
And, there might be, some of you out there that maybe deal with a local bank now. Maybe you've dealt with that bank for a while, and the way that we normally see this, we talk about specialization a lot. The way that we normally see something like that working out is that, as a firm will keep growing, keep expanding, their needs keep growing. All of a sudden somebody at a more traditional bank will take a look and say, wow, there's no collateral there.
Yeah.
And, then we'll see some of our prospects, our clients will start reaching out to us as they start hitting limits, at some of the smaller traditional banks.
Right. Yes.
And, so those are the things that, we're kind of differentiate what we do a little bit from some of the other people, especially in that aspect of collateral.
Yeah, great point.
So this actually leads into my next question, and that is, how can I run my company on a daily basis to best prepare for an acquisition? We talk a lot about preparing on a grand scale, but what are the things that business owners can be doing day to day?
So for me, I think it's taking into account what things look like post-close. I always touch on this in these webinars and things that we do. A lot of folks, I feel like, look at integration as like an afterthought. Okay. It's more important to focus on the numbers, the EBITDA multiple, the revenue multiple, and what have you. And I think to prepare your firm for an acquisition, I think you have to really understand of what it's going to look like after you close. What is the repaper process going to look like? Is it positive or negative consents? Who's going to be managing what clients? Who's in charge of the investment strategy for clients that haven't met you yet? These are foundational things that I think need to be brought to an advisor's top of mind as they're preparing for a transaction.
Okay, great. Rob, do you have anything?
Yeah, I would add, one of the things that really makes a successful transaction in our standpoint for especially an acquisition is, to give somebody like Adam a call, before you really get into the weeds on something like this. Don't wait until you have an actual transaction sometimes to pick up the phone and make an introduction or meet somebody, because those conversations are so much easier to have on the front end than when you call Adam and say, hey, I'm trying to close an acquisition in a month.
Right.
And so those make it a little bit challenging. And then also the strategy about having a strategy. Why does this make sense? We talked about it earlier. My right to exist. Why does this make my firm better? And being able to explain that, instead of, hey, it gives me the opportunity to grow. Okay, well, great. But what else does it do for you? Does it add people? Does it add talent? Does it add another line of business maybe you're not in? So kind of working through those. So why does it make sense? I think those are the things that, as I think about early on, what makes a transaction go much smoother for us is having those conversations up front, having them early. So that, when we're in the weeds together, we all know where we're going.
Yeah.
Yep.
It just makes it so much easier.
Yeah, that's a great point. Just to add one thing, our entire sales staff, we see deals all the time. This is all we're doing. Most of the stuff we're doing is either change of ownership or M&A related. Mm-hmm. So a lot of the time you'll hear our staff say, hey, give us a call when you're looking at a deal before you get into an LOI. Right. Because the worst thing that can happen on our side is we get an LOI that we can't do this, right? So then we got to go back and retrade the seller, and you're already starting off on the wrong foot. Where, to Rob's point, if you touch on some of that stuff up front and you get in touch with us early, generally we can tell you, hey, this works, this doesn't, maybe change this a little bit. So when it gets to Rob's side of the house, it's it's in good shape.
Good to go. All right, great advice for our listeners. Thanks, guys. So how does commercial loan underwriting differ from consumer loan underwriting?
It's funny, Adam and I just had this conversation a minute ago, and really on the commercial side, we use dice, and figuring out whether we do something or not. Totally kidding. Hopefully everybody knows, obviously kidding. Really, as you think about consumer lending, you're thinking about, as I think about, walking through a grocery store and I see something I think I like. Maybe I look at the price. Maybe I look at the back to see how much sodium's in it because I got high blood pressure. And so I take a look at a couple things and decide if I want to get it or not. Right. When you get to the commercial underwriting, we're more interested in how did you make the sausage. Let's talk about how you made it. We go into much greater depth where on a consumer loan you might be looking at a credit score or a handful of other things. For us on the commercial side, we're looking at, we talked about those 5 C's of credit. We're looking at all the things. What's your company's history? What have you done? Where are you going? How successful have you been? And really going much deeper. And people who haven't borrowed money commercially before might find that a little intimidating sometimes. Sure. And, that's why, again, having that relationship with a guy like Adam beforehand, so he can kind of walk you through, hey, here's kind of the things we're going to want to know. Here's kind of how the process is going to go, makes it so much easier. So when you get into that process, you have that expectation and you're prepared to talk about those things.
The only thing that I would add to that is on the collateral piece that we just touched on. I think evaluating the collateral is much different in this business for all those things that we mentioned before. Evaluating the book of business, revenue concentrations, client tenure, that's very different than a commercial or a consumer, evaluation when you're going to buy a house. Right. When you go to buy a house, how much money do you make? What's the appraisal? What's the loan to value going to be? And same with a car or any other consumer type of product. But when we get into the commercial side, we have to take that a step further, right? There's a lot more diligence that goes into it. Yeah, right. A few.
Yeah.
So, and we've sort of been talking about this all along, but how does Oak Street Funding underwriting process differ?
I think one of to me, the biggest differentiator between us and a lot of folks out there doing similar things are, when you're working with Oak Street, you're going to get an underwriter that comes alongside of our salesperson. Once you kind of get through the transaction with the salesperson and underwriting gets involved, you're going to see, the underwriter take a bigger step forward than you will at a lot of places where you might not even know who's working on that transaction. So, depending on the size of the transaction, you might have Adam and an underwriter come out and visit your firm. You're going to be on the phone with those folks. And so we really get the understanding of, who you are, where you're going, and what your goals are so that we can, as we're going through our process, we're trying to align those things. and make sure that we're all moving in the same direction.
Yeah, I mean, I couldn't agree more with Rob. Rob and I have worked together for the past 7 years. Our departments work much closer together than a typical bank. And, we both worked for other banks in the past and done different types of lending. With this type of lending, it's almost like we assemble a deal team up front that's, more catered to your individual needs and the transaction's individual needs. So I think when you bring that underwriting side all the way up to the front, it creates much more smooth process for some of these more complex transactions.
Makes total sense.
Yeah. And, we're talking, we're getting ready to go visit a client. Adam and I are with another underwriter. And, these are the things, a longtime client, but, they're going to have access to management. They're going to have access to, the people that are actually making the decisions. And so we're going to sit in their office. We're going to get to hear the story firsthand. And, that's something that most people can't say. And, I think that's something, especially in the kind of lending that we do, that's allowed us to be successful, is that we can ask the questions, we can understand, the motives behind our clients and what they're really looking to do.
Love it. Okay, I have one last question for you both. How can I improve my ability to present a strong case for approval during underwriting?
I'll start off on this one. This is my area of expertise, right? So, I mean, at the end of the day, I think communication's key.
Yep.
Clients that turn stuff quickly are very clear. We don't like surprises, right? Surprises when they get to Rob's side of the house usually involve changes in the deal structure or pricing or, something that's not going to go well. So to present a strong case, I think you really have to have your ducks in a row, right? You have to have all your information organized, neat, clean. And you have to be able to get back with us in a timely manner. And we got to understand, hey, is this a priority for you right now? Where does this lie? So I think just being upfront, communicating with us effectively and answering questions in a way that's very easy for us to understand is big.
Absolutely. And, we just talked about it, but review and know your company, know your financials. I think those are the, when and I know that it's sometimes very painful because sometimes we ask a lot of questions.
We do.
We do.
You guys know.
And so, but and that's and understand, frame your mind that we're doing that to try to get to know your company, but being able to provide answers quickly and in a timely manner is important, because one of the most frustrating things is sometimes asking a question and getting, well, that's, I don't know, and it's something that and it's fine, you don't know, but being able to find those answers quickly and helping us kind of go through the process, and it is something very powerful for us.
Great.
Yeah, and I'll add one last thing to that. I think a lot to Rob's point, asking a lot of questions in there, seeing how you respond to that is big for us on the character side of the 4 C's. I remember some of the C's. So that's a big thing that's going on in the background that I feel like a lot of people don't realize. Yeah. When we submit you a laundry list of questions that are, thoughtful questions around your business and its historical financials and the acquisition itself, be mindful that part of that is seeing how you respond. Right. So I think it's a big thing.
Great advice. Thank you both for being here. I really appreciate it.
Thank you. Thanks.
And thank you to those watching and listening. And don't forget to tune in to our On Point podcast episode, Deep Dive into the 5 C's, Understanding Credit, where Rob joins us to discuss further underwriting. Available now on our website and wherever you listen to podcasts. See you next time.